but it has to be so much better, so much faster, and so much cheaper for there to be a switch. And that's why people like investing in software. It's just the order of operations describes what you are. The quality's first, and then I gotta meet all these criteria for growth as well too. And then at the end is my valuation.
Welcome to Investing for Beginners podcast. Today, we're going to have a lot of fun. Today, we're going to talk to our friend Braden Dennis from Finchat. He is the co-founder and CEO of one of my favorite platforms, if not my favorite platform to learn about stocks. So Braden, welcome back to the show for the gazillionth time.
Who's got the record? That's all I want to know. And whoever it is, it's not me coming for them. But it's always great to chat with you guys.
It's either you or Brian Feraldi. So I'd have to go back and do an audit, but it's close.
You know what? Brian's a better teacher and smarter than me, so he can have it. I like Feraldi.
Well, it's awesome to have you back again. And I thought maybe we could start off with a nice, easy one. So markets have been kind of crazy. So how are you dealing with the volatility, and how do you think others should kind of handle all the craziness lately?
Just comes down to, what are you looking for as an investor? Like what brings you here to the market? You know, you show up to the bar on a long road trip, like, you know, what brings you here? And I think it's a pretty valid question to ask investors. And if it's what brings you here, returns over the next 3 months, anything under 3-5 years, then you have something to be concerned about when the market draws down 10 to 25%, as it does very regularly, by the way. But if it's not, and what brings you here is you're going to try to compound your wealth and take your hard-earned dollars and compound it year after year for the next several decades, then there's nothing to do really other than just keep going on.
Tariffs don't scare you.
I'm a Canadian recording this year in Toronto, Canada. I just crossed the border. I was shocked they didn't. I just show up home from Florida. I was shocked they didn't throw a 25% tariff on my car as I crossed the border. I was expecting that. I mean, look, markets hate uncertainty, right? Most analysts want to have some sort of spreadsheet that can tell them the future and have some sort of perfect lining up of numbers. And the more experienced you get, the more you realize that that's a useful exercise, but you can't kind of base your entire thesis on. The future is unknowable. The world's hard to understand. There's a lot of moving pieces. There's a lot of inputs. Capitalism is beautiful in the sense that things change because there's new competitive forces. And so the news here is there is going to be material changes to some businesses if they're to come into effect and be lasting. The problem that markets are just not going to settle on, and it's just going to be bumpy ride until there's some sort of clarity. And right now there's been nothing but clarity. And, most people are saying that the president and the administration is using this as a negotiating tactic. Whatever it is, all we know is that Wall Street can't settle until they know what's going to happen with global trade. I think that that's pretty obvious and reasonable. However, back to the first question, what are we looking for here? If you think that this is going to be a lasting problem for the next 10 years, then yeah, we've got problems as investors in equities. But if not, then things will work itself out. I mean, I was a lot more nervous when there was a global pandemic about to massively disrupt how people interact and global business than I am around a potential tariff trade negotiation between some countries. I'll put it that. So what I am doing is investing like I always do every month and more so when there's a drawdown. So that's what I'm doing.
Do you think it's your investing style, your investing personality kind of lends itself to that? I mean, we mentioned, for some businesses, commodities may be a good example. It can really wipe them out, but depending on your risk tolerance and what kind of stocks you pick, maybe it doesn't affect you. So do you feel like for yourself and your stocks, your strategy, does that all kind of play into your mentality?
Yeah, well, I will say the businesses I own, I don't look at as like, this is a big concern just because of the nature of what they do. But if I was a holder of some things that have been massively waxed, like logistics, I think of a couple companies that move a lot of goods across the Canadian border. I look at CP, CN Rail, for examples. Those companies have all had a pretty rough year to date, no question. And those businesses are just absolutely rock solid with some unclear business unit economics over the next, few years. The problem with these companies and their management team is they're basically going to be, until there's some clarity, they're basically just going to have the most miserable earnings calls ever. Like, I would not want to be the CFO or CEO of those companies over these earnings calls. It's like, what's your CapEx plan? Like, how are you going to invest? And like, we don't know, because this affects our ROIC numbers in a major way. So I just don't envy being any of those CEOs of those logistics companies over the next however many quarters, because it's just an impossible earnings call to conduct. And the analysts will ask those questions anyways, even though they're impossible to know. That's how these things go. So I don't envy them. Personally, I'm not too exposed to it, but yeah, I don't know if I have a better answer.
What have you been exposed to lately, or has that stayed pretty consistent for a while?
I have basically owned the same kind of 10 core positions for nearly 10 years at this point. A lot of technology, no question, a lot of acquirers, a lot of software acquirers where those two kind of meet in the middle, payments. I like to invest in businesses that receive unfair unit economics because of the position that they're in, and they get disproportionate value accrued to them because of the business that they're in. And so businesses, like you mentioned, like commodities, you can make lots of money. You can make tons of money in anything cyclical. It's just not what I think I'm particularly good at. I don't want to time the cycle. I don't want to figure out when exactly you're going to get things right, when the macro's right. Those are all things that, if you're really good at those, you can make tons of money. I'm just personally not. I want to know the business that they're going to be able to raise prices 5 to 10% next year, and their customers will absorb it. Those are the businesses I want to own. And there's a lot of them out there. You got to get it in some sort of strike zone between quality and moat, management team, and price. That's the Venn diagram strike zone. And you typically have a lot of companies that get 2 out of 3 of those right. But maybe you get first quarter 2025 where all 3 of those things line up right in the strike zone, and that's where you want to be.
So how do you find those companies? Obviously, we use Finchat, but but what like how do you find those companies? Like, how do you find the companies in the Venn diagram strike zone?
Yeah, I have 2 main sourcing ways. Is literally just observing. I think it's so important to just observe. I'm the guy who like is at the restaurant and there's like some fancy thing that they bring you, and I'm like, who makes this? Like, you're on the train and you're like, who makes the handle on the, like, I'm curious about all these things. And usually it's private companies, but there's every once in a while they're publicly traded. So I'm just trying to observe as much as I can. Got lots of good examples of that. I'll give you an example, and then I'll get to the second way I source companies. But I finally bought Uber stock at the end of last year. And this has become a bit of a battleground stock because what's going to happen with autonomous driving and vehicles and all that stuff. I've always admired the business once I realized that they had scale and it was going to be basically impossible to create Uber again because The path to that is burn another 50 billion of venture capital money. And like, that's not happening with interest rates at zero anymore. So I'm like, okay, that's interesting. I got off a flight. I flew home from New York. It's a small airport in Toronto. And I get in the elevator and it's a big elevator. So it fits like 15 people and all their luggage. It goes up, it brings you to the main terminal. It's a really small airport. And on the elevator, everyone puts their luggage down. They rest it beside them. They pull out their phone. And I was standing there. There's 15 people. And every single one of them flipped up their phone and pulled out the Uber app to get their ride home. I was like, I got to look at this business again. I told myself that it's uninvestable. The unit economics are garbage, blah, blah, blah. I reserve the right to change my mind. The unit economics are not garbage. The take rates went from 12% to 28% while the ridership doubled. How many businesses can double their take rate, double the price, and double the traffic or the amount of customers, the amount of volume, the amount of transactions? So that's the example of like the data supporting the anecdotal thesis. Okay, so that's an example. The second one is using a screener. People like screeners. Some people hate screeners. I personally like them as a good place to hunt. If I say, okay, I'm an investor in companies that typically grow over time, have these levels of unit economics, they're profitable, I can get there's 65,000 active listings on Finchat, right? 100,000 if you continue the discontinued ones, but 65,000 active. I have to have some sort of systematic way of bringing together my universe because I can figure that around 50,000 of them I'm not interested in right out of the gate. Okay. So then we can whittle it down, and you can get some sort of hit list to do research on. And for me, I keep like a workbench of around 5 to 10 companies that I have done all the research I need to, that I would consider adding them to the portfolio. So that list is around 5 to 10 companies. An example of a company that sits in there right now for me is like TSMC. Amazon's another. Those are two like larger cap examples. I have some smaller ones as well. And then I have like another watch list of around 50 companies of I have to do more work on them. At one point or another, I've thought that they're super interesting. And maybe they'll get into that 5 to 10 list and maybe into the 15 companies I own eventually.
You want to spill the tea on what kind of a filter, what kind of a screen you like to do?
Yeah. So I do like seeing consistent top line growth, consistent growing operating margins, and a fairly reasonable balance sheet and a fairly reasonable valuation. And so most people with a screener, they'll screen like low PE or like they'll screen like low valuation. Valuation is the last thing I do. So I think that there's an interesting discussion around like if you're a valued investor, a growth investor, a quality investor. What I've learned is that all of those are valid. It's just the order of operations that you tend to go with kind of describes what you are. Okay. And so for me, quality's first, and then I got to meet all these criteria for growth as well too. And then at the end is my valuation. I don't like going the other way. It doesn't mean that I don't care about valuation. I care about it deeply. It's got to be the last checkbox to get it in the strike zone. But it is last because for me, I like studying businesses. I like studying how they work. I like reading how they operate. I like listening to the earnings call. I like looking at the deck and hearing what other analysts think and understanding the business and what makes them tick. I don't love looking through spreadsheets, but it's a necessary evil. I got to do it at the end, but I do it last, or else I would just burn out. I like looking at the other stuff first. And other people like doing it the other way because they like going through the spreadsheet. Like my co-founder, Adrian, he's an accountant. He likes doing all the stuff I don't like to do. That's what makes us a really good combination. And I do the stuff that he doesn't like to do. So I think that you got to kind of pair those well. To answer your question more succinctly, Andrew, Dev Cantasaria of Valley Forge Capital defines quality investing as the intersection of growth and predictability. And I think that that's a good way to analyze what I'm looking for with these companies is, okay, I know that they're growing. I know that the number one return decomposition for equities is revenue growth historically. That is by far proven the most valuable factor in return decomposition is revenue growth. Okay, so I know that, but how do I predictably know that in the future? And that comes down to the quality of the business. Company you own, company I own, ASML. I'm pretty confident in their position of the future looks pretty great for that business. Like in the quality and the understanding of what they do and the bottleneck that they exist in to all computing, I'm pretty confident in the predictability of that business. Of course, semis are cyclical. Don't have to get into the nuances of that, but I am confident over the long term that I can predict what they're going to do over the future. And the growth is there. So that would be a kind of a good example of where growth and predictability lie. S&P Global, FICO, Moody's, Visa, MasterCard. Those are pretty good examples as well.
So how do you determine durability? That's the thing I struggle with the most. Is like, how do I determine what's durable and what isn't?
Yeah, this is the hardest thing, right?
Can you give me a metric?
Yeah.
Can you give me a number that just makes it super easy, right?
I will. Okay, let's use it. Let's use an example right now. Nike, one of the most iconic brands of all time, is in a 65% drawdown on the price of the stock today. 65%. Okay. You would think Nike, very durable. I'm wearing a pair of Air Force Ones right now. I'm looking at them right now. I love Nike shoes. And I own some of their competitors, the Hokas. I own those shoes as well. But I love Nike. I love the brand. It's always been iconic. It's like the millennials brand. If you're to like think of like the most iconic company, and very durable in a lot of ways, in many ways, very, very durable. But here's where things get really interesting as an equity investor. Okay. The stock does, the company does, I have to pull up Finchat, like around 45 billion in sales. Okay. That's about the top line. 35-ish of it 2 years ago was footwear. Okay. Footwear revenue. So 30 of 45. So selling shoes is a good chunk of the business. Of course, they sell clothes. Of course, they do other things. But 30 of 45 on the top line is shoes. That number over the last 2 years has ticked down to 30. So there's been 2 years of sequential negative growth on Nike footwear. And if you just look at top line, you just look at profits, you just look at the brand value, you think, is this an overreaction? The stock's down 65%. Is it really 65% less valuable? And I think this is a rude awakening. I think me as a newer investor would say, do the math. You know, the revenue's down single-digit percentage and stock's down 65%. That's a valuable buy, right? That's a very logical thinking. It's a rude awakening for investors when a story changes title. Okay. So what this means is if something goes from a growth story, aka people are buying more and more Nike shoes over time, to a slow growth story, that's tough for the stock. That's always tough for the stock. Okay. That happened. So you saw that in the equity about a year ago. It's been on a long slant down to the right. Bad chart. Okay. That happened. You got punched in the gut. Okay. Now it moves from a slow growth story to a negative growth story. Oh no, boom, double gut punch. You got kicked while you're down. And so I think that people can do the math. I'm an engineer, so I'm doing the math. I'm like, there's value there. It's a rude awakening for investors when you have a huge narrative shift and story shift on the business from a growing, predictable story to a slower, but maybe predictable story to, oh, there's real competition. Kids, adults, old people are not default buying Nike shoes. The business can still do well. It can still be an iconic brand, but that is a materially different story, and you'll get a re-rating on the stock. 30 times earnings turns to 12 really fast. And so that's a quick way to, without the jargon, that's a quick way to lose money really quickly.
It's a great example. I remember it doesn't seem too long ago, maybe 6 months ago or something. My timeline's completely jacked, so maybe this isn't completely accurate, but like they were just down 25% or 30% not too long ago. Yeah. And it seemed like, oh, this is the great buy the dip story. And people who did buy that dip learned this lesson the really hard way.
Yeah, when the dip dips. Right. And then continues. Now, I don't, it's not my kind of company. I have a rule, no fashion. So I won't be owning the stock, even if it is tremendous value here. It's more of a learning, unfortunately, the hard way for equity holders of that can matter a lot more than the math. And you think, oh, it's detached from reality. It's not the fundamentals. It is the fundamentals. It is the fundamentals, without a doubt. This used to be a company that was growing and people loved that story. And now it's like a kind of a turnaround story, right? Those are so different. Starbucks, another perfect example, right? Starbucks and Nike, like the millennial iconic brands. People are looking at other options. Gen Z maybe doesn't like it as much. People who are now coming into buying power and being economical don't resonate with those companies as much as the previous gen. So, Dave, to your question about durability, it's really, really hard. And you have to remain pretty humbled around what you can foresee in the future. Because what seems like a sure thing lock for a lot of investors in the late 90s was like so wrong by 2002. In that tech bubble kind of unwinding and everyone's prediction of the future, right? So things are really, really unknowable. But there are a lot of companies that have such wide, immense moats. A buddy of mine texted me the other day. He can see Visa's moat from space. That's what he texted me. Like, that's a really good example of like, people want to innovate away from it and you just can't. So there's a lot of examples like that. Like LinkedIn is my favorite business, I think, ever right now. It's, of course, owned by Microsoft. They bought it at around $1 billion in revenue. It does $16 billion as of their latest filings in top line. Can you think of a more defensible company? It's like social media, but you're not hopping on the trend of Snapchat versus Instagram. It's literally like your professional. No one's looking for another LinkedIn alternative. Like, it is just such a defensible business. I like companies like that where, yes, the future is unknowable, but I have a high degree of certainty. It looks more like it does today than it does today.
Yeah, those are all great examples. As being like the software guy, I might have asked you this question in the past, but obviously I haven't learned the lesson if you answered it already. How do you, being somebody who invests in some software businesses like Constellation, also being a founder of a software business, how do you determine durability in a business like that? And is it different from like a social media like a LinkedIn or even like a Visa kind of thing?
Yeah, it totally. The latter two examples are network effect businesses. They're both technology companies, but they're network effect businesses. On the previous side, there's a few moats you can build with technology software companies. You mentioned Constellation Software. That is a holding company of like 1,000 software companies. You could argue no moat business, but no one executes like them. So that's just like a betting on that's a Warren Buffett betting on the jockey, not the horse type of company. So in terms of software companies building moats, QuickBooks, fantastic example. Okay, QuickBooks is owned by Intuit. This is a business where it's bookkeeping, accounting software. Most startups are using it until you get to like later stage. People tend to kind of move on to something else, but you could keep potentially using it. Every accounting firm will be ready to do your year end on QuickBooks. Any bookkeeper will be ready to do your thing on QuickBooks. If I create a new QuickBooks alternative, I have to then now educate the entire professional services world on my business. And the customers will go, why? And the service people who perform those services for the customers of QuickBooks will also say why. So you have to do better, faster, cheaper in every industry. Better, faster, cheaper. That's a good recipe, whether you're making cars or you're making software or whatever you're making seat belts for airplanes. Better, faster, cheaper is just the ingredients for success. It's like salt and oil for a chef. Those are the ingredients to make something delicious. And better, faster, cheaper with software can come in a lot of different ways, but it has to be so much better, so much faster, and so much cheaper for there to be a switch. And that's why people like investing in software, because it's really hard to make something that is all three of those so much better, so much faster, so much cheaper for you to switch. So then you have companies like Constellation Software that acquire these type of niche vertical market software businesses because no one wants to switch off of them. And even if you do switch off of them, the retention rates still are fantastic and you have pricing power built in. You know, your software, Google just sent me an email like 5 minutes before we started recording that our per seat cost I have 25 employees. The per seat cost is going from like $13 to $15 like next month per month. And I opened it and just pressed back. Like, what am I going to do? It's like, what the hell am I going to do? Like, go switch it off? Like, oh no. Like, so that's the kind of pricing power baked into these companies, right? It's fantastic.
So switching costs being a big one a lot of times, like the Google example, like you're really going to spend all this time to rehash everything, restructure everything to save on a 5 or 10% pricing increase. Yeah.
Now with Finchat, we want to do more stuff that is a little bit more personalized to your user. That's going to just be really powerful, obviously for you as a user, but for us as a company. So that would be a good example. And then on the data side, okay, I'll give you an example. We're the only platform that has all of the KPIs in there. Okay, all of that data. It's like the core fundamental data. It's like if you wanted to know how many nights are being booked on Airbnb, if that's going up, or like what the gross booking value of that is compared to Booking Holdings, compared to Expedia, like how much volume is going through the platform, just like compare apples to apples. We have all that data. That data, aggregating it, the technology we built around doing that is an accounting nightmare. It's like impossible to even describe how difficult it is to do that well at scale for 65,000 companies, right? So that'd be an example of like a technology advantage. Someone can come along and try to compete with us on it, but again, it's really hard. Like, who wants to go do what we did? So what they'll do is they'll just come use our API instead. They're like, okay, too hard, too expensive, just use our API. Now all of a sudden we are integrating as the underlying data layer proliferating ourselves across other fintechs, other brokerages, other platforms. That's an example of like where you can start to build a moat when you have really, really hard things to rip out, like we're sending and receiving data from other companies.
I work really hard to find the best insights I can every single month at Value Spotlight. To see a sample of my previous work, go to stockwriteup.com.
All right. So I guess what are your thoughts on the whole AI thing? So you work with it, and I'm curious what your thoughts are on just generally, and then maybe we could talk about kind of what's going on in the markets and how people are reacting to it.
It is no question like frame breaking type of technology when you can think of like what it could be. There's no question. The ChatGPT moment is now years in the past at this point, which is kind of a crazy time warp, November 2022. And so since then, you basically have had all kinds of different trends. Every year's had the different trends. So the 2023 trend was the chat interface. 2024 was the agentic trend, which is basically like you have an army of 5,000 interns in the sky, and each one can go do something, and they work 24/7 for you, and they can work together, and they can do all that. And then reasoning came out, which is basically like, okay, now those agents have like actual like thoughts around how to do the task. It's like, okay, the user's telling me this, like, let me break this down into steps. So now you're starting to see like how the things can kind of all come together to, instead of being something that can do your kids' math homework, to being like a workforce that lives in a cloud. And the workforce that lives in a cloud and has actual reasoning and can perform tasks is game changing for a lot of knowledge work. And so when you see Microsoft, Amazon, Google, Oracle, whoever else spend hundreds of billions of CapEx on building this, I don't think that there's been any better rationale for it than when Gavin Baker of Atreides Capital was asked, like, why are they doing this? Why are they spending all this money? What's the return? Isn't it going to get commoditized? Bear case reasons X, Y, and Z. And he said, if you can create digital God, does it matter?
Wow.
And it's like, part of me is like, you know what? Okay, there's got to be some sort of digital God has to have some sort of cost. You can't just spend on like an sideways 8 unlimited amount of money. But for these companies that are generating hundreds of billions in free cash, that have the opportunity of creating digital God workforce in a cloud, what the right amount of money to spend? Is it, what percentage of cash after you've made the shareholders happy is an acceptable amount? You've paid them their dividend if you pay one. You've bought back godly amounts of stock. You've checked those boxes for them. You have just unbelievable amounts of cash flowing back. You're still investing in the business heavily with R&D and maintenance CapEx. What's an acceptable amount of billions after that to spend? And I guess the response from the market and from these tech CEOs has been whatever it takes. So that's kind of where we're at right now. It's been a couple of years of that.
It has been. So have you started to see examples of use cases where people are starting to use it in your line of work and maybe in others?
Yeah, I mean, coding's a huge one. You look at a company like GitHub and all the data they have with everyone's code written, GitHub Copilot. I mean, every single one of our engineers have a subscription to that, plus Cursor. We're floating with other things like Windsurf, and there's so many tools that are coming out. There's this new trend around like vibe coding, which is basically like, do I even need to write any code? Can I just go from start to finish on an application by just telling the computer what to do? I'm a little bearish on extrapolating that to like, it's going to kill all of software, right? Like that,
Right.
I don't think that that's a pretty fair extrapolation. I think that it's going to help the efficiency of those companies to create more software. But if you vibe code something start to finish, any hacker will just be able to, go through it like a piece of Swiss cheese. Like it does not have the right controls being built into it. There's a lot of spaghetti code that kind of comes out the other side. But it's Q1 2025. What happens in a few years, right? Like, how does that keep getting better? So I think we're on this cadence of like the technology gets better every single month and at an exponential rate. So what's the limiting factor? I think that we haven't really found one yet, but it is going to continue to get better and also harder to get better over time. The use cases right now have been in knowledge work. I have seen some pretty amazing examples of the workforce in the sky example. Say you have paperwork. Let's use a real kind of like where blue collar meets knowledge work together. Okay. Say you're a shipper and you have bundles and bundles of like bills of ladings and paperwork that's created nonstop. You're just like the people who work in that part of the business, whether they're a manufacturer that ships stuff out or a logistics company, you're just creating so much documentation and it's all regulated. It's all regulated. So you have to keep stuff for 10 years. It's got to be filed away in a certain way. You get audited, blah, 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 blah. All of that digital or all of that non-digital assets that are being created, someone's doing the paperwork of uploading it to some secure database so that when they do get audited from a regulator, that they can pull it up and they don't have to go flip through warehouses of binders, right? This is happening in basically every industry. So you can think of other examples of where this type of thing is happening. I like Naval's quote. Naval Ravikant, for those who don't know him, founded AngelList, Silicon Valley investor, entrepreneur. He had this, he always has these kind of tweets that I call Navalisms, which are fantastic, which is save the paperwork for the robots. And I really like that because it's like, oh, AI is going to disrupt jobs. It's going to remove people's jobs. All of that might be true. There's been lots of technological advancements that have changed the way that people work. Is paperwork the one that we really want to hang on to? Like there's a lot of amazing creative jobs that like, yeah, that should be for the humans. Music's an example. I never want robots to take over music. That would hurt my soul. There's something about music and the creative process, something about art. These are things that robots are really good at, yet no humans want robot art. It's this, there's no soul in it, right? The paperwork, it never had any soul to begin with, like let's automate that stuff and have people do more productive, more creative, awesome things that humans are actually good at. So it sounds really dystopian. I sound like some sort of tech CEO dystopian, like we need to remove jobs. No, it's not that. I don't think anyone's going to be too upset about the paperwork moving to the robots. And guess what? Doesn't matter what I think. It's going to happen. It's happening now. It's going to happen. So position yourself accordingly.
Have you guys seen that tweet of the robot that's like scanning a book automatically? That's kind
No.
of crazy. No,
What is it?
It's like the robot, I don't know if it picked up the book, but it basically had the book in its arms, whatever you want to call the robot's things. And then it was scanning really quick, flipping the page, scanning, flipping the page, scanning, flipping the page. It was like a machine, and it looked like you could just feed books into it. And then you would see the scan on the computer screen. And it was doing it really fast. So it looked like you see in the movies of a coder who's just, his screen's going up and down like super fast. That's what.
That's example of like where it can flip it and then use a vision model to take and extract all the data, all the unstructured text data from it and throw it into something else. Like that's an example of there's a lot of valuable structured and unstructured data all over the world that AI is going to basically rip out, because there's no Silicon Valley, Stanford ambitious entrepreneur that's like, there's a lot of valuable data in there, I'm going to hire 10,000 people to extract it. Like, that's not going to happen. It's going to be done with AI.
Anything investable in that space right now to you? Looking at equities, looking at that strike zone of stocks that you like to look for.
Yeah, I'm always kind of looking at the infrastructure layers, the TSMCs, the ASMLs. Look, we need more compute. We need more energy. I don't love investing in energy. Investing in utilities is really, really hard. It's like, yeah, we know we need to double the utility structure, but like, you can't double the capacity in 5 years of the US grid, right? So like, no matter what, it's a slow growth industry, even if you need more and more demand. So that's not too exciting, even though we have to get there eventually. So I'm looking at the infrastructure. We need more compute, more data centers, and better technology on that compute, right? So ASML shoots a microscopic laser at a piece of molten tin that the human eye can't even see at the perfect angle to then refract it onto silicon wafers so that you can make 3 nanometers or less silicon on the wafer so that you can make beautiful GPUs sold to NVIDIA, right? Like, that technology is unbelievable. It is, generational type people working there. Everyone who knows anything about that industry works for ASML. And they have kind of like a regulatory angle happening there too, where it's like, don't even think about it, China, like, so it's kind of like everyone ex-China, ex-Russia gets the benefit from them doing that. So they're kind of up the stack. Next to the stack would be their customer, which would be TSMC. TSMC is obviously, I don't know if you guys talked about much on the show, but it is one of the most premier assets on planet Earth, which is the foundry fabricator for all modern silicon being made other than Samsung, and they're kind of different. So a quick primer on the semi industry is, the business used to be very vertically integrated, like Intel, meaning the designer is also the fabricator, meaning I design the chip that's going to go in the Apple Macintosh computer, and I'm also the one who manufactures it. Okay, that was Intel's business. As more and more designers came online, the NVIDIAs of the world, they outsourced all of the quote unquote manufacturing foundry business to contract manufacturers like TSMC. And they have been day one partners as outsourced foundries for the entire industry now. And now everyone uses them. And why would you not? It makes no sense not to. So I think that they're a company that frequently goes on sale because there is China-Taiwan concerns. And the companies that get disproportionately affected in their stock price are the ones that are closest to the sun. What I mean by that is, if there are issues with China and Taiwan geopolitically, which company is going to get hurt more than the one with Taiwan in the name, right? Right. In terms of price action. Why doesn't that same discount get applied to Apple? And last time I checked, Apple's not making any phones without TSMC. Last time I checked, NVIDIA is not making any GPUs. No one's getting any cars. There's nothing's being made without them. So I find it hilarious and also grateful that there is those kind of disconnects in the market between reality and perception. And that's another company that's de-risking that by building in other geographies and diversifying from the geography of TSMC. So that's a fantastic, just a wonderful business and very well run, good founding story. And I probably should own the stock. I don't know why I don't.
Story of our lives.
Yeah. Can't own them all, right?
Nope, unfortunately. All right, folks. Well, that was a fantastic conversation. I hope you guys enjoyed it as much as we have. So, Braden, we have kind of hinted around with Finchat and whatnot. So, where can people find more of what you have going on personally, as well as what's going on with Finchat?
Appreciate it. Well, I love that you guys are users of the product. Andrew, I get your newsletter every month, and I see you using it in the charts for the research. So that is great. The website's called finchat.io. Think of it as like Yahoo Finance on steroids. Okay. That's like the way to think about it. It's a lot more clean, easy to use, more professional, if you will. And then I'm on a weekly podcast called The Canadian Investor. We talk about Canadian stocks about 10% of the time and US stocks about 90% of the time. So it doesn't matter kind of where you are. I think you might like the show. That's the Canadian Investor.
Awesome.
Did you guys start a new one too?
We have the Canadian Real Estate Investor now too. Not hosted by me, but other guys.
No, none of it's like AUM thing.
For the Finchat pod. Yeah. We're interviewing other asset managers. It's called AUM. It's like under the Finchat brand.
Right.
Ryan Henderson's doing the pod. So he's interviewing like various asset managers, people who have made it in investing. So like if you're listening to this and you want to do investing professionally and learn from those people, that would be a good resource.
It's a great show. Yeah, I've enjoyed it. I've listened to a couple of the episodes so far, so I've really enjoyed it.
Yeah, we'll have to get on Mr. Warren Buffett next.
That would be nice.
Is he doing any podcasts?
That would be a pretty good get. For sure. All right.
Thank you though, guys. I appreciate it. It's always super fun to chat with you guys. And you guys are like my day one podcast buddies. So appreciate you guys.
Well, likewise, we appreciate it as well. So in all seriousness, check out the podcast, check out Finchat. It's definitely worth your time and effort. Easily the best investment platform out there. So I am biased, but I'm not wrong. So with that, I will go ahead and sign us off. You guys go out there and invest with a margin of safety, emphasis on the safety. Have a great week, and we'll talk to you all next week.